Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, April 14th at about 7:30 Mountain Time. This week, our note was titled Made in America, a little bit of a play on what President Trump would like to happen with a lot of the products we consume here. But in essence, Made in America refers to the $36 trillion of debt that the bond vigilantes came out in force to try and protect last week. So the note this week discussed sudden stop economies as an analog for what had happened. Remember, we made a call a week ago that we thought it was time to take a stand on the equity market. We did obviously get a 5% or so rally last week, and we're still confident around that call. But one of the things we warned about a week ago was that the president's trade agenda could derail the most important of Treasury Secretary Bessent's arrows, which is getting the deficit back to 3.5% or so of GDP. And from our perspective, there is only one way to do that. You cannot tax your way out of it. We must reduce spending back to 20.5% of GDP from its current 24 to 25% level. And that is at the core of what happened last week. Yes, we know people were concerned about Chinese selling. That doesn't make a ton of sense to us. The offshore yuan CNH barely moved last week. We had big rallies in the yen and the euro and rallies in gold and Bitcoin, which implies there is some concern about dollar assets for sure. We're not mitigating that. But the real story we saw in things like swap spreads, and which is a measure of supply and concerns that the House agreed to a Senate budget resolution that requires no spending cuts. The administration seems to think they can raise $600 billion from tariff revenues. We think those numbers are high. But the problem is that could very well cause a recession, which would widen the deficit further. We could go from 6-7, and Biden did deal Trump a pretty bad hand on all this, but we could go from 6-7% to 10% in a straight line were we to go into recession here. So this is the core of the problem. The debt problem was made in America. We need to deal with that first. Congress cannot get weak knees about that. And so in some sense, the bond vigilantes kind of have the equity investors back here, but that is the core of the problem. A couple of other important things happened last week. CPI and PPI were supportive of our thesis that this trade policy is much likely to be a bigger demand shock or have a bigger impact on demand or be a demand shock than it will have any sort of lasting price effect. You cannot have inflation without accommodative fiscal and monetary policy. Inflation is always and everywhere a fiscal and monetary phenomenon. And so we saw it in economically sensitive sectors, energy being first and foremost, airfares, used car prices. Even though we have tariffs coming in on new car prices and a surge in sales, used car prices went down. This is a more of a demand shock than price shock. The Fed has this completely wrong. So the earnings season is going to really start to pick up steam. Not so much this week, but the next week. We're going to see whether revisions can start to bottom out. In our view, when you look back at these sudden stop economies like 1980 and 2020, you get fairly shallow earnings recessions. You get 20+% market declines. But in essence, the market decline prices a recession in fairly short order. And that's what we think has happened. But again, we need the bond market to act as a check on President Trump trying to reorder the entire trading system, in a quarter. So it'll be another interesting week. Barry Knapp from Ironsides. Once again, we'd love you to consider becoming a full subscriber, get all the details, and we do our best to try and help you make good, informed decisions. Please, again, consider becoming a subscriber. If you want a trial, send us an email. We're happy to give you one. Thanks, Barry Knapp. Have a good week.